morning, everybody, and welcome to this panel, Navigating Asian Markets, Strategies for Long-Term Value Creation. My name is Terry Minke, representing HSBC, and I'm delighted to be joined by Daphne Chester, WFM Asia, Jing Ning, Cephei Capital, and Sean Ho from Triata Capital. Let me start off, if I can, by asking the panel here to just explain a little bit about who they are and their firms. If I could start with you, Sean.
So, hi, everyone. I'm Sean from Triata Capital. I'm the CIO and founder of our fund. So we're a Greater China Long-Short Equity Fund, currently around 800 million, 16 people. We focus onshore. So our offices are in Shenzhen, Shanghai, and Hong Kong. So we run on-the-ground due diligence. But how we're different is we triangulating using alternate data. So because of Triata Capital, using a lot of digital information to do a lot of research from a deep fundamental perspective.
My name is Jing Ning. I'm the CEO of Cephei Capital. Cephei was founded in 2006. In the past 18 years, we only do one thing, which is invest in Chinese equity market on behalf of global institutional investors. So our investor base includes pension funds, sovereign wealth funds, family offices in North America, Europe, and Middle East, and Asia, of course, in this part of the world. We're running about $5.5 billion for clients. For me, I've been an investor for 25 years, 20 years investing in Hong Kong, China markets. Before joining C5 this year, I'm recently new. I worked for Fidelity for 10 years and BlackRock 5 years.
Good morning. I'm Daphne Chester. I'm the president of WFM Asia, which was founded as Ward Ferry Management in 2000. We are an Asian equities, Pan-Asia, long-only manager. So we focus on small and mid-cap investments. We currently manage around $3 billion on behalf of primarily US institutional investors.
Thank you very much. I'd like to start with the current state of the Asian markets, if I may. It's been an interesting 3 or 4 years. We've seen a slight pivot in terms of trends away from China, which has obviously proved some challenges, into perhaps India and Japan. We now start seeing that pivot back slightly. It's early days, but it's clearly a trend. Sean, if I can start with you again, because it's impossible to really talk about Asia without talking about China. It's an incredibly important part of the region and the world. Do you see this trend continuing back into China? Or do you see short-term challenges with Trump coming in, potential risks around tariffs, et cetera? How do you see China and the state of the market today?
Yeah, so we think there will always be a geopolitical risk challenge, especially with the US-China situation. It's taking a lot of headline news. But at Triata Capital, we are very fundamental bottom-up perspective. So instead of a top-down view, we look at individual companies and try to understand the competition. So if you think it's actually quite interesting, we think a lot of people are looking at the China space more from a beta perspective. We really think the opportunities is really generating alpha, right? So if you think about China from a fundamental bottom-up perspective, we are focusing on the competition between each company, say within the e-commerce space. How is PDD and Alibaba competing? Like who's gaining what sort of competitive edge? What are they doing nuances on the ground, bottom up? So China is a big country, right? So we think overall, if you look at China, domestic opportunity is great enough, but there's a lot of overseas opportunities, et cetera. So in terms of a few statistics, right? I think when a lot of people are looking at this, first of all, China is around 17 trillion GDP versus US around 25 trillion, so around 70% of USA. But right now in MSCI China index, US is around 63%, whereas China is only 3%. And out of that 3%, I think most people are underweight China. So it's running around 9 percentile in the past 10 years average. So it's very underweight over that. So if you look at overall in terms of the allocation, I would say China as a global perspective is definitely underweight. But even beside that, beside looking at the flow, et cetera, we are very long-term focused. We think from a bond market perspective, there's a ton of opportunity to generate alpha on both sides. So our long alpha is roughly around 8% CAGR, short alpha 12% CAGR, et cetera.
Thank you. Perhaps I could turn to you now, Jing Ning. Same
Yes.
question, your views.
Same question. I think from investor perspective, when they look at Asia, I mean, China has always been competing with India historically on the growth story, right? Every year you need to figure out India versus between India and China who deliver the better growth. But that story, the narrative has changed quite a bit in the past 4 years. I think policy headwind is one concern, a geopolitical concern is that add another layer of complexity to it as well. And now when people look at Asia, right, if you go for growth, there's India. And then if you look for value, and there's Japan, right? So where China sits in the middle, I mean, the position is a little bit awkward. I mean, China, on top of that, China has always been a very tough market, right? You know, I think for me, there are two cycles in China. One is economy cycle, the other is policy cycle. And they always go against each other, right? As a contrarian investor, you follow the policy cycle. So when the policy turns, when we hit the policy inflection point, that's the timing to buy China. But that logic didn't work in the past 2 years, right? We have seen rounds of policy responses since after China ended COVID zero policy. But the market started to lose conviction on the policy response. And then we have seen, and then at the end of September, we have seen a policy shift to fiscal easing and monetary easing. And there are a lot of people very skeptical about this, whether this is just another round of policy responses, it's going to die down in a day or two. But our view is this time is very different. I think we have hit the policy inflection point on September 24th. Simply, I think in China you have, unfortunately, we only have one decision maker within government. And I think he has changed his mind on many economy policies. So just basically, everyone was caught by surprise in September. It tells you the policy direction is coming from one person and from top down. So it doesn't matter. We are debating on whether it's enough, whether we should see rounds of fiscal policy, whether they should continue to ease property market. I don't think that's very relevant. The timing itself is important. Everything else will come second-handedly until they achieve the objective. And then, in the past couple of weeks, we have many of our investors, our clients, are waiting for the second shoe to drop, which is US election. Right? Although people talk about it, and I think analysts, strategists has priced it in their 2025 economy model, but people still want to wait until the dust settles. And now I think the election has been concluded. I think going into 2025, with valuation being very attractive, we have policy tailwind this time around. And the geopolitical situation, I think that people has priced in the worst scenario. So we are kind of very constructive on the market for next year.
Great, fantastic. A follow-on question, perhaps, in domestic confidence in the market. Savings rates domestically in China have never been higher. Typically, that market has benefited from domestic retail money into the market. The view is there could be a wall of money when domestic confidence raises. That will go back into the market. Do you see that happening anytime soon?
I think from our point of view, I think the stimulus measures that came out in late September were great. And that was much more significant than anything they'd really done to date, and certainly to be encouraged. But in our view, what needs to continue to happen is they need to consistently, over the coming weeks and months, continue to roll out similar measures, right? And continue to kind of up the ante. And one of the things that we personally don't think they've done enough of is direct consumer stimulus, right? Like getting money directly into kind of the pockets of consumers so that they start to spend again, right? Like the savings rates historically in China have always been high compared to other kind of countries globally, and they've only gone higher in the past couple of years with the uncertainty. But if you can unlock that spending, whether it's going back into the stock market or going back into the real economy, that is hugely powerful. But from our point of view, that's what they need to focus on, is getting consumers to actually start deploying capital again.
Thank you. Let's switch slightly to other markets in the Asian region. There's been a lot of foreign directed investment into other ASEAN economies, which they're starting to benefit from, but the market is broadly, allocators are again underweight EM. What other ASEAN countries or Asian markets get you excited at the moment from potential opportunities? Maybe Daphne, if you could start with you on that one.
Sure. So we've long invested in ASEAN, going back to kind of 2000. And for us, ASEAN really means kind of three key markets, which are Indonesia, the Philippines, and Vietnam. We do have some investments here in companies listed in Singapore that are much more like pan-ASEAN businesses. But we remain very excited about those three markets. We added a bunch of exposure back into ASEAN in 2023. And I'd say, again, we do small and mid-cap. And I'd say the mid-cap names have done quite well in those markets. But what's really challenging about ASEAN still is just liquidity, right? And it's at kind of the less liquid end of the markets here in Asia. And so it will just take time, in our view, for the capital flows, particularly the foreign capital flows, to flow back into those markets. But in terms of like the quality of companies, and for a period the valuations were more attractive. Things have gotten more expensive now, but in terms of like the quality of the franchises you can buy and the kind of getting access to the number one and number twos and whatever their kind of sector are, ASEAN is very exciting. We just had team members in the Philippines last week, and compared to a year ago, like our view of on the ground, this kind of sentiment in the Philippines alone is much more positive and much more dynamic. And obviously certain ASEAN countries are benefiting more from the kind of move to offshore a lot more manufacturing from China, right, and diversify manufacturing out of China. So Vietnam has long been a beneficiary of that, and you're starting to see that across ASEAN as well, other countries in ASEAN.
And Sean and Jing, I know you're predominantly focused on China. However, as Daphne mentioned, a number of companies who are setting up manufacturing outside of China. Is this something that you look at too and you're focused on, and any other countries that you're getting excited about as a result of what's going on with some of the Chinese companies that you follow? Jing, if I could start.
I think this is totally agree with what Daphne has said about this, the opportunity we see from many Chinese companies going international. So this is actually very different from the traditional OEM, ODM export story. So, China has been the world manufacturing house for decades, but this time around, I think that the narrative has changed quite a bit. For many Chinese corporations, they are seeing their international strategy is pillar around where do I put my manufacturing base in Vietnam or Thailand, or do I need to set up a new R&D center in India, or how do I engage the local distribution and the local supply chain to help me to penetrate further into the international market? And some of the ASEAN countries are in a very sweet spot in terms of consumption destination for many of Chinese manufacturers. So many of the companies we hold in the portfolio, interestingly, the marginal growth driver for the next 3 to 5 years is not actually coming from domestic market, it's actually coming from international. And by international, so actually, if you think about from balance sheet and P&L perspective, it's a great plus for them. It reduced the cyclicality of their top line revenue. So when China is not doing well and the rest of their market is doing quite okay, and then they have more access to talent and to capital by going international. So we don't directly invest in some of the local listed stocks, but we actually do quite a lot of work and as part of the cross-reference for the company we own in the portfolio.
Yeah. So it's actually quite interesting, right? So we did a lot of channel checking within a lot of the manufacturing, et cetera, in Dongguan region to see if they're expanding overseas, especially after Trump got elected, the potential 60% tariff. So a lot of them, they are actually already are planning ahead to see like how can they maneuver this situation. But like Jin sort of mentioned, we see a lot of different opportunities within a lot of these Chinese companies going overseas, right? So if you look at the traditional ways when it's everything manufacturing in China in the past decades, if you look at the production smile, like that's in the middle part where the margin has historically been the lowest. You actually see a lot of Chinese companies going to the more front end, which is like innovation, developing, et cetera, and try to have a competitive edge over there, or to a more backer end, which is direct to consumer, building up the brand value, et cetera. So these are some of the companies that we did a lot of research within. We're thinking, you know, their competitive advantage, could that be sustainable throughout different time, right? So it's quite surprisingly, right? A lot of people, when they look into invest in China, when they're debating is China investable or not, you know, in the US, if you look at top 5 downloaded app, actually 3 of them is actually Chinese company, right? So like Shein, TikTok, and Temu, et cetera. So there's a lot of different, I would say, have a Chinese company have a very strong competitive edge expanding overseas. You see that in the EV segment, you see that in the retail space, you see that different brand popping up, et cetera. So in Shenzhen, you actually see a lot of the overseas e-commerce player where historically they've just been manufacturing, but now they're creating their own brands, having more of a strong competitive advantage.
Yeah, interesting, thank you. Daphne, I'd like to switch completely now to risk management. It's been quite an incredible second half of the year so far for the Asian markets and the volatility that we've seen. And there's a fair prediction, I think, that that will continue actually, and now that the Trump administration is in, we're very likely to see more volatility. Can you talk about risk management and how your firm applies risk management? Because it's becoming ever increasingly important in these markets to allocators. So it'd be really interesting, your views on the volatility and how you manage that volatility.
You know, we're an Asian long-only equities manager, so to a certain extent, you have to be tolerant of volatility, right, to manage our strategy. So, you know, I say that in jest, but it's true. Like, and we have to say, we say internally, like, volatility needs to be an opportunity for us. And what we mean by that is, like, volatility is just part and parcel of investing in Asian equities, particularly when you're long only. So, you know, what we need to be able to do is view it as an opportunity, meaning if a stock's down 20 or 30%, we should know with certainty like why that is and what the kind of short, medium, and long-term impact is, and hopefully be able to add exposure, right, and to kind of take advantage of the volatility. But the other kind of way that we build in kind of a natural hedge to our portfolio, because we can't actually hedge, is we focus a lot on having a very high percentage, typically like north of 75% of our companies be net cash companies, right? And if they're net cash companies, that means they can continue to sustain their growth plans no matter what's going on in the capital markets, right? They can kind of self-sustain whatever their initiatives are. And what we don't want to do is wake up one day and obviously find out that one of our companies is like running out of cash and going bankrupt, right? So, and that's certainly not been the case in our portfolio today. So that's kind of how we manage it. But we talk openly with clients about how volatility is kind of part and parcel of the game and how we manage through volatility. And I think, you know, doing this for as long as we've done and managing equities in Asia, like you kind of have a playbook for how you manage volatility. But, you know, in China, for example, too, you know, which has been very volatile the past couple of years, we'll focus on, you know, having companies that we feel like will be out of like the regulatory lens, that are really domestic economy driven, not exporters, right? So you try and can also manage your kind of type of exposure to the types of companies you're investing in, but you are going to weather volatility just in these strategies. You know, I think the final point I'll make is that really, you know, what you want in these markets is just ensure that you don't kind of have like a volatility hangover, right? We're also aware of like not wanting to be cute on market timing, right? If you're trying to be too cute on market timing, you will just miss. Like these uplifts happen very quickly, like happened at the end of September. And if you didn't have your exposure on in that first kind of like 24 hours or didn't already have exposure, you missed a lot of the uplift in performance, right? But then we were then trimming a bit in October. Like we had 2 names we exited because they'd reached kind of our price targets through that re-rating in September. So it's a very dynamic process, imperfect process, but dynamic.
Yeah. How about yourself, Jing?
We are a long-only manager as well, and then exposed to one single country, cyclical economy, very retail-oriented market, tells the whole story. But I think the situation today actually is better than a couple of cycles we experienced before, because we are seeing more and more companies start paying dividends. So dividend has never been a culture for corporate China, right? You go for the top line growth and you go for the next great opportunity. You care less about buyback and balance sheet strength and paying dividend. But we've started to see companies shifting to more shareholder-friendly framework. Part of it is private company, they're going through family transition, and they need a second generation, need a very stable financial income. And then state-owned company, there is a big push from the policymaker, ask state-owned company to pay dividend to fill the gap on fiscal deficit and the social security deficits. So dividend is becoming, for the first time in history, if you look at CSI 300, the dividend yield is higher than the 7-year Chinese government bond yield. Now it's giving you a dividend yield about 3%, which is not very shabby if you compare with the history. So owning a higher percentage of high dividend yield stocks will help us to mitigate the downside risk in the cyclical market as well. And the second thing I want to say is, if I look beyond China, right? So, and the correlation between different asset classes has definitely risen a lot in the past couple of years. And it seems everything is driven by one single macro story, right? Remember I think the early August, when the yen-dollar trade was unwinding, it created so much volatility in the market. It almost felt like there's no place to hide. And that put China as an interesting place because we are sitting on the other side of the spectrum. We're running our monetary policy and the fiscal policy are very different in very different part of the cycle versus the rest of the world. So if you think about from the asset allocator angle, how do we enhance return and reducing the risk correlation of the risk in a portfolio? China is quite an interesting chip on the table.
Yeah, and Sean, you're long short, giving you a few more options here. So how do you manage your risk in these markets and actually take advantage of them as well, of course?
Yeah, so for us at Triata Capital, we are long short hedge funds. But on the long side, I actually strongly agree with Daphne in terms of the investment philosophy. We don't think volatility is the same as risk, right? We view risk more as a permanent loss of capital. That means on our long side, we would like to do enough work that show confidence throughout different time from a bottom-up perspective, know what the company is doing on the ground, the competition landscape. Are they able to continue to grow their revenue or earnings and have that strong competitive advantage throughout the long run? We believe not knowing your company well enough, especially on the long side, that is more of a risk versus the volatility. Because the volatility of the market, if you think about it, is not really by owning or investing in the asset class itself. It's actually by trading and supply and demand by people trading around this asset class. In China, by definition, as an emerging market, oftentimes give you that opportunity where great companies that could be traded at a very distressed valuation. And that's actually where we take an advantage to actually double down or buy in. So I remember last year, there was a company that we bought in when it was trading below their cash value, whereas their main business, etc., is still growing very healthily through time. So that really helped us our return when the stock later went up 2-3x. But that's more on the long side, right? So we really view it's more important to do the work fundamentally bottom up. But on the risk management side, how we segregate it is not looking at the stock price in terms of stop loss, but more as a fundamental factor. So once they reported earnings or any alternate data that we collecting on the ground, if it's starting to go against our thesis, that's when we have a team discussion and say, hey, is this the time to stop loss? Is our original thesis still continuing to play out? If we believe the thesis is not playing out, then we stop loss and get out the position. But on the short side, it's actually quite different, right? Because short, you have unlimited upside where the stock could go. So we have much stringent and strict on the stop loss side and much higher in terms of the risk management side. So for risk, each of the names, when they move around more than 15%, it will send an alert, we'll document our process, et cetera.
If you're hitting those losses, I mean, depending on market conditions, you're prepared to stay, or do you cut? Your losses are your losses. But in the intraday risk that we've seen in some of the markets, you're happy to stay with some positions as well?
Yeah, so long and short, again, for ourselves, the investment philosophy is slightly different. Yeah. So the long side, similar to Daphne said, we actually benefited a lot in September of this year because we are a very long-term holder. We don't believe in market timing in a lot of these, right? Especially when we see great company trading at a very depressed price, that's when we go in and we stay there, we invest in a very long time. Even if the stock market goes down even more, our question to ourselves is, what is the market representing? Are we wrong? How is our alternative data tracking? How is our on-the-ground words tracking, et cetera? Is there anything against our thesis? But on the short side, regardless of the fundamental factor, we have a more stringent stop loss because the risk reward is different. So our risk management over there is really diversifying into more names. So generally, it's about diversifying within the names and not focus or fall in love in terms of one stock only.
Got it. Thank you. In the interest of time, I just want to finish up with one last question, which is important along the theme about strategies for long-term value creation and the markets that are going to deliver that. I think I know the answer to this question from yourself, Sean and Jing. But Daphne, if I can start with you maybe, which markets over the next 3, 5, 10 years excite you the most in terms of long-term value creation for your shareholders?
Well, I'm sure my panelists, colleagues here will talk about China, so I'll leave that alone. But I'll mention Japan briefly. And what I think is very interesting about the setup in Japan is that while it's obviously been a beneficiary of the capital flight from China, it's done well, it's attracted global attention. That kind of re-rating in Japan has also been very narrow, similar to the US, right? In terms of kind of what has done well in Japan, right? So it's what they call the Samurai 7, like the semis and kind of the less than 1 times price to book companies. That's been the trade that's done well. That means that there is a lot of the Japanese market that has done very little, right? And we do think these structural reforms in Japan are real. We do think they will continue, and we think it will just take time for them to trickle down to kind of the companies that we tend to like on a more fundamental basis, which again, our focus is small and mid cap. So we do think this kind of re-rating in Japan has a lot more that it can do over the coming years. And so we think that's exciting. You can still deploy capital in Japan today without feeling like you're buying at expensive valuations, that you're buying once the stock's already up 40, 50, 60%. But it may take time for that to be realized because the attention is still very much on like large cap, mega cap Japan.
Thank you. And Jing, China.
Yeah, China. Actually, I want to say, I mean, not particularly on China, right? I think in the next couple of years, we're going to see many what I call Chinese multinational companies. So they are becoming less domestic and more international. So you cannot say whether they are. I mean, they probably have 30% of the revenue coming from Europe, and then from Latin America, Thailand, and a little bit from US, and then the rest from domestic market. It's very hard to say whether you can define them as a Chinese companies, right? I mean, there's a reason if you look at the S&P 500 versus Russell 2000, right? There's a clear multiple difference between the two. And I think that one of the reasons is S&P has a much higher percentage of multinational revenue in that versus Russell. So I think for this company, I think it's not only about getting exposed to additional market and getting the intelligence from the additional market, it's also about the valuation recreation. When they go international, and I think the investor will look at them not from a domestic China perspective, but probably the valuation would then, the question is, what's the right multiple for these companies?
Yeah, so we actually quite agree with Jing. Within the China market, I think on the ongoing phase, the competition is very high with a big domestic market. So we're starting to see that in various aspects, right? We focus more on the TMT and consumer segment, whereas within the consumer side, for example, you see Luckin Coffee has way more stores in China versus Starbucks, right? So our question at Triata Capital is how do you find some of the great company that can continue to expand over time, but even globally throughout different time? Like, could you find like the Nike, the Coca-Cola, the Apple, et cetera, for the China company that not only do well domestically, but in the long run, because their competitive advantage is so strong, competing very fiercely within the China market, once they win out, they have that strong competitive advantage that they can continue to expand globally, right? Within US, within Europe, within other region of the country. We think that's quite an interesting place to look at.
Absolutely. Well, I think we're just about to wrap up. So Daphne, Jing, Sean, thank you very much. Incredibly insightful panel. Thank you.